Hey guys, so today we're going to talk about the 5 key areas that really drive what happens in the housing market. And some of this information is going to really run contrary to probably what you've seen in the media and maybe what friends and family are telling you. In some of my conversations with business partners and clients, it's really clear to me that some of our biases around what's happening in the market are shaped by our past experiences. So as we go through this, I want to reframe some of the narrative of the past through use of some clarifying data. So let's jump right in. The first of the 5 areas is inflation. For the last 40 plus years, inflation's been pretty well managed. But when the pandemic hit, our government rolled out a $5 trillion plan to keep our economy afloat. In addition to all the stimulus, the government also bought huge amounts of bonds to keep interest rates artificially low as inflation was actually starting to increase. Ordinarily, when inflation begins to pick up, the federal government would start to raise short-term rates. But because they believed it was going to be transitory, they waited. With too much money in our system chasing too few goods and enhanced by the supply chain issues, we saw prices go up on everything from services to food to fuel. And in October, we hit peak inflation of around 8.6%. Inflation can have devastating impact on consumers, but it also impacts the federal government's budget. So they've had to take massive action to try to get inflation under control. The federal government has one major lever to use to try to manage inflation, which is increasing the federal funds rate. This is essentially the amount of interest that is charged to banks overnight. When the government increases or lowers rates, they're attempting to either increase or slow down spending. And because the government waited so long to raise interest rates, they've now hiked them by 400 basis points, which will inevitably cause a recession. So how does a recession impact the housing market? If we agree that a recession is upon us, it's important to understand that recessions tend to be deflationary, meaning there's less money in circulation because there's less borrowing and potentially more savings. It causes the economy to go through kind of a retraction period and less expansion. This tends to reduce inflation in the long run. So how does this impact home prices? In 9 of the last 10 recessions, we've seen home prices actually rise, with the outlier being 2008 market crash. But the Great Recession of 2008 isn't what caused the housing market to collapse. It was actually because the supply and demand were so far out of balance. Back in 2007, we had more than 3.5 million homes on the market. One of the main factors driving inventory levels was the amount of new construction. From the period of 2000 to 2010, we built 12.5 million homes as a country. And on the other side of this coin is demand. And of course, demand is driven by many factors, but the key factors are going to be affordability and household growth or household formation. Take a look at this chart that reflects the amount of homes built versus household formation. And you can see in the early 2000s, there was a huge imbalance of the number of homes that were actually built versus households that were formed. And we ended up with way too many homes available for sale. However, when 2008 hit and the financial system collapsed, home builders essentially stopped building new homes. And in fact, from the period of 2010 to 2020, home builders built roughly half the number of homes that they built in the prior decade. So from the period of 2008 to 2012, we were essentially trying to balance out the market. With less new homes being built, most of the people were buying homes that were already on the market. And as you can see from the charts, household formation started to increase while new construction did not, which has resulted in a supply and demand imbalance that was opposite of the prior cycle. In fact, we have way more people hitting their household formation or their home buying years than amount of homes available for sale, which is exactly why we've seen home prices go up so quickly in the last few years. So what does this all mean? The first point is we don't have a supply issue. We currently are sitting at around 1.3 million homes on the market, with already 500,000 of those under contract. Now there are some regional markets that definitely have an oversupply of homes, like a Las Vegas, for example, where they currently have an 8-month supply of homes. So if we don't have a supply issue, then there must be a demand issue to account for this slowdown in housing right now. And the reality is demand right now is tied to affordability, because when you look at household growth, there are plenty of people that are going to be hitting their home buying years over the next 20 years. In fact, it's a record amount. So currently, our view of the market is that the demand is all tied to affordability. And this is directly correlated to interest rates. Currently, interest rates are at a peak level, and we haven't seen interest rates this high in many, many years. When rates come back down as they're forecasted into the 5% range, we should see demand start to increase in a significant way and home values start to appreciate once again. Based on CoreLogic's most recent forecast, we could see home prices increase by as much as 4.1% nationwide in the year 2023. If you made it this far, thanks so much for watching. So please hit that subscribe button and we'll see you on the next one.